Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
So welcome everyone to the latest episode of Provident Healthcare Partners podcast. What we're discussing here today is the tax implications of a transaction, something that's very important for shareholders to consider as they begin their planning and preparation process around a potential deal. Just as a friendly reminder, Provident Healthcare Partners is a healthcare-focused investment banking firm. We provide merger and acquisition advisory services exclusively to healthcare services companies, but certainly from a tax perspective, these points are going to be helpful regardless of the specialty that your company operates in or the industry group. So just as personal background, I'm AJ Shekar. I'm a vice president with Provident, and I've been with the firm for about 8 years. I'm also joined by a colleague of mine, Dustin Thompson, and Dustin, I'll allow you to introduce yourself as well.
Thank you, AJ. I am Dustin Thompson. I am also a vice president at Provident, and I've been with Provident since 2013.
Great. And we're lucky to be joined by a guest today, Yaury Jattin, who's a principal at Kaufman Rossin Tax. Yaury has a lot of experience in the advisory element around tax implications for a transaction, and we're excited for her to join us here today. Yaury, welcome to our podcast here.
Thank you so much, AJ and Justin. I'm thrilled to be collaborating with you today. Like you mentioned, I'm a principal at Kaufman Rossin, which is a CPA firm, and I've been with the company for 16 years.
Terrific. Welcome, Yaury. We're excited to have you as well. If you wouldn't mind for our listeners, could you give us a brief background on your firm, some of the areas that you focus on, and what the typical client or engagement looks like for you?
So we're a full-service CPA firm, provide a variety of services from traditional audits, tax and accounting services to sophisticated business and risk advisory services. Specifically, when it comes to the healthcare industry, given that that's your guys' focus, we provide performance improvement services, transaction advisory consulting, as well as integration consulting, cybersecurity, HIPAA and High-Tech Act compliance, as well as business valuations and outsourced bookkeeping and CFO support services. For me particularly, I focus on mergers and acquisitions, tax planning, and corporate tax consulting. I spend the majority of my time working on transaction advisory services pre and post-transaction, from tax due diligence to helping our clients determine the optimal tax structure, to estimating their net after-tax cash flow, and finally ensuring that the transaction is reported correctly on their tax return.
Terrific. Appreciate that background. I know the flow of our conversation today is going to be a lot of just Q&A around general topics of interest from a lot of our clients, and Yaury, I'm sure a lot of your clients as well, as they think about a potential transaction. So Dustin, maybe you can kick us off with the first kind of typical question that we get from clients around a potential deal, especially from a tax standpoint.
Yes, exactly. Thank you, AJ. Our first question any potential seller asks of us is, what type of tax treatment can a business owner expect from an M&A transaction? Because ultimately, when they're selling their business, there are some implications that come into effect here, which change the taxes from what they're typically seeing on their ordinary income. Can you go into some details of what we should expect if you were to sell your business?
Well, the first thing to look at would be the company structure. We need to understand how the company reports for tax purposes, whether it's a partnership, an S corporation, or a C corp. The treatment of a transaction would be different. And it depends whether they sell assets or stock. But typically, a component, depending on the structure, you could go from just capital gains, which are taxed at 20%. And if the seller or individual is active in the business, that would not be subject to the additional 3.8%. It would be just the 20%, or it could go up to the ordinary income tax rate if it's an asset acquisition, and depending on the assets of the company.
Yeah, that's helpful. And I think one typical thing that folks don't necessarily realize is, how that tax is levied. I think some may think that it's based on kind of the full enterprise value, but there may be some bits to sellers, especially if they have basis in the company. Is that right, Yaury?
Definitely. Also depends on the structure, whether the seller has basis in their interest in the company or their assets, depending on how the transaction is going to be executed. If we're talking about an S Corp or a C Corp, the gain is going to be whatever proceeds they receive minus transaction costs, minus their basis in their stock. If it's a partnership interest that's being sold, then their basis is going to be the partnership's tax basis in the assets.
Yeah, the typical situation we're in, we're advising, sellers in these transactions, and the goal is always to maximize the capital gains treatment, especially given that differential of tax rate between capital gains and ordinary income. And, what we've observed is that, especially if you're able to maximize that capital gains treatment, it really augments what the deal economics mean for a potential seller. Because let's say, a deal is valued at an 8 times multiple of, the profitability that the group otherwise distributes out to themselves as distributions every year. Some people think about it as, 8 years worth of foregone income that you're getting up front at closing. But especially when you factor in the benefit of capital gains rates, it actually extends that, break-even period further down the road, which I think is a very powerful, tool as sellers think about the tax benefits of a transaction versus ordinary income rates.
And this is something, we like to work with the seller early on in the process. Once, an LOI is received, or even when we're just in the valuation stage of the possible cash that a seller is going to receive at closing, as well as at different bogeys, whether it be an earn-out, escrow release, even a sale of the second bite of the apple in a 5-year period of time. So it can show the potential cash they're going to have, obviously, like a financial planner outlook on the company. Ultimately, we like to work with either the seller's internal CPA, or we have a number of CPAs such as Kaufman Rossin on hand that we're able to provide access to, so that they can work with you and ultimately determine what the benefits are going to be here and how you can maximize the wealth at this stage.
And I would agree with you on that, because a lot of times we're trying to make the transaction tax efficient. But what I think we're really trying to do is to maximize the amount of cash that the seller is going to receive once the transaction closes. And that may mean that, believe it or not, they may pay a little more tax, but they can still negotiate a higher purchase price and still end up with the highest amount of cash possible. So it's not just the tax efficiency of the transaction, but how much can you negotiate that purchase price depending on the structure and what the buyer is trying to accomplish.
That's a great point. And, taxes come into play regarding the entity structure. And as you're aware, there's several different entity structures that we're dealing with from a legality standpoint. So would you mind touching on kind of the entity structures you see and the advantages and disadvantages that those can come into play during the transaction?
Well, when you have an LLC that is taxed as a partnership, typically those transactions are going to be treated as an asset acquisition, right? So there's not much to negotiate as far as the purchase price and as it relates to taxes. There's going to be, depending on the assets of the company, whether they have significant amount of assets that have been depreciated, what accounting method they use for tax purposes, there could be an ordinary income component to the sale of the company, and there's not much that can be done about that. Whereas if you're selling a C corporation or an S corp, there is a very significant difference sometimes on whether you sell the stock or sell the assets. Because if you sell the assets, there's going to be that ordinary income tax component. You typically pay more taxes if you sell the assets than if you sell the stock. If you sell the stock, you're looking at only capital gains. And that's basically the difference between partnerships and corporations. Now, there are certain elections that can change a sale of stock and the treatment of a sale of stock into a sale of assets, but we're going to be talking about that a little later, right?
Yeah, absolutely. And, I think some of the common pitfalls that we tend to see are that, especially as companies are reorganizing themselves into, let's say, an S Corp and, embarking upon a transaction within 5 years of doing so, we can see oftentimes a built-in gains tax with those sorts of transactions. And then from a C Corp perspective, I think you were getting at this as well, that, with some of these, transaction structures, especially from an asset standpoint, that there could be a double taxation standpoint as well.
Correct. And these are the negotiating points you may have with the buyer, because typically it's for the buyer's benefit that a seller of a C corporation or an S corporation would agree to sell assets. They are the ones that are going to get the benefit of a higher basis in the assets that they will get to depreciate or amortize. But this is going to cost the seller additional cash, right, in taxes. So that's definitely something that needs to be considered when you are looking at the different structures available for selling your company.
Yep, and that's a great point. As you mentioned, leading off there was structure of the company. And as far as structure of the sale, we see, two types of sale, an asset sale and a stock sale. Would you mind providing some details, as far as an asset sale and who's it advantageous for, as well as a stock sale?
So, like I mentioned, typically a buyer want to buy assets and a seller would want to sell stock, right? If you sell stock, 100% of your gain is going to be taxed at the lower capital gains tax rate, so 20%. If you sell assets, and depending on your balance sheet, you may be looking at a portion of that gain being taxed at ordinary income tax rate. So in instances where a company is on the cash basis of accounting for tax purposes, where in fact has significant accounts receivable, to the extent that any of the purchase price is allocated to accounts receivable, that portion will be taxed at ordinary income tax rates. The same goes for depreciable and amortizable assets. If to the extent that there's value in those assets and the company has been amortizing or depreciating these assets for tax purposes, a portion of that gain is going to be taxed at ordinary income tax rates. So companies that sell assets are looking at both types of gains. There's going to be a portion taxed at 20% which typically is the majority of the gain, but still there's going to be a portion that's going to be taxed at the highest ordinary income tax rate, typically on the numbers, which is 37%. And it typically costs the seller more money to sell assets than to sell stock.
And as far as asset sales, a lot of the assets go to goodwill, because ultimately the revenue producers are the physicians or other providers when we're talking healthcare practices. We're not working with a technology or a industry company that is, heavy into fixed assets or property, plant, and equipment, which can definitely be skewed more favorable on asset sales when you're looking at different types of industries. Ultimately, though, this is something we like to review beforehand, definitely before we're closing a deal and try to allocate items. But as accounts receivable was mentioned, nearly every deal has some sort of working capital and accounts receivable that is included into here. So on an asset sale, there is going to be some portion attributed to ordinary income, whether it's 25% or 5% of the overall purchase price. It's going to vary from deal to deal, but we still would expect a large amount of that to be taxed at a lower 20% rate. And something to consider with a stock sale, as far as the buyer, there's definitely some risk because they're buying the stock of the company, and it creates purchase liabilities that they're ultimately inheriting. Now, that can be worked through if a buyer is hesitant and says that's why they can't do a stock sale, through our purchase agreement, which will have reps and warranties and identifications to it. Now, ultimately, prior to ever getting into a signed purchase or signed LOI, we will determine if it is an asset sale, stock sale, or sometimes it just says it's going to be advantageous to a seller. So we will agree on it at a later time, but ultimately we can point back to that we need to make sure if there is any additional tax liability because the buyer wants it structured one way, that we can be trued up on those funds, and we will work with a CPA that is a tax expert to find out what the difference would be on our ultimate tax liability if we were doing a stock sale or asset sale, so that it can be trued up.
Definitely, and that's what I spend the majority of my time doing, right? Whether sometimes representing the seller, sometimes representing the buyer, we want to make sure we quantify that differential, right? And the seller is made whole for the additional tax that they have to pay. And a lot of times it's not always the tax benefit that the buyer receives. Tax savings that they receive over time from depreciation and amortization is so much larger than that bump in the purchase price that's needed to make the seller whole for the additional tax.
And would you mind providing an overview of what a 338 H10 is? That is something we see in a number of transactions because it ends up giving the buyer what they want as well as helping the seller out from a tax perspective.
Well, a 338 H10 election is an election that can be made when the buyer and the target entities are corporation. And it's basically an election that allows an electing seller and buyer to treat the transaction as an asset acquisition. The transaction is legally a stock acquisition, but for tax purposes, it's treated as if the corporation sold its assets and immediately liquidated. Now, the consequences of a 338 H10 election are slightly different to a C Corp shareholder than they are to an S Corp shareholder. A C Corp shareholder would end up paying double tax if you think about it. The corporation is deemed to sell its assets, and it would pay tax on the gain at the corporate level, and then it makes a liquidated distribution to the shareholders, who then pay tax on the difference between that liquidating distribution and their basis in the stock. Now, if the company has NOLs in net operating losses in a C Corp scenario, they could use these losses to offset any gain. So the seller would not be in a bad position if they elected 338 H10 election. They may still be willing to do this. On the other hand, if the target is an S corporation, and we go back to the issue of the ordinary income tax that's going to apply to assets such as depreciable assets, amortizable assets, and receivables if the company is in the cash basis of accounting for tax purpose. Then, since the company is deemed to liquidate immediately after the transaction, any basis that the shareholders have in their stock can be used to offset the capital gains on the sale of the assets. Dustin mentioned this election gives the buyer the best case scenario, right? The most beneficial treatment of the transaction. They will get to step up the assets and obtain the tax benefit of depreciation and amortization. The seller, however, is still exposed for that additional tax on the ordinary income tax rates. And I typically do that. A lot of the transactions that I work on calculating the gross up for tax are 338 H10 elections and F reorganizations.
Great. And I think a common theme that we're hearing these days, and the common question that we're asked, especially around an election cycle, is where do you see capital gains rates and where do you see overall deal-related taxation going in the future? Obviously there's a number of factors at play that could sway things one way or the other, but you're just interested in getting your take on where your firm's expecting rates to go in the near term.
Well, if there's a change in administration, right? And it would have to be in both branches of government, right? Executive and legislative, for the democratic plan to come to fruition, right? You may be aware, I'm sure you guys are aware, that Biden's plan wants to increase the capital gain tax rates to the ordinary income tax rates for individuals earning more than $1 million a year. And not only increasing the capital gains rate to ordinary income tax rates, he also wants to increase the top ordinary income tax rate from 37% to 39%. So without a crystal ball, it's hard to predict. However, what I'm advising my clients to do is to wait a little bit. Everybody's a little stressed out. Most of my clients are a little stressed out about the capital gains tax rates increasing in the future, they're looking at ways to maybe accelerate realizing gains as to pay the lower tax rate now. I'm advising them to please wait until after election. They have almost 2 months to push the button if they decided to, if it's necessary to realize the capital gains this year. Now, remember, even if Biden wins, the Democrats would have to have the majority of the Senate also for anything to happen. So I'm not going to say it's highly unlikely or it's going to happen. I can't predict the future, unfortunately, but what we do have on our side is the fact that you can wait. You have 2 months to make that decision ultimately.
Yeah, but I think all that's great information. And ultimately, at this stage, being in quarter 4 of a transaction, if you're just looking at exploring a transaction right now, ultimately it's going to likely occur in 2021 anyways. So we will definitely receive more certainty on what your taxes are going to be and educate you along the process. So if the transaction is something you're considering, we could start now and move forward with it, knowing that there's going to be some uncertainty when we create models for you of what your proceeds are. But ultimately, if there were to be any changes, it would likely be occurring, over the next 4 years. So it's a question, do you want to do a transaction in 2021, or are you planning on waiting till we have some major changes, which could be 2025 or beyond? So that kind of uncertainty or any impact here could continue for some time. Yaury, we appreciate your insight into the future of taxes. Ultimately, I think it'd be great if you could expand upon what you have been doing as far as transactions and working on within the past few years, and that would be great as we look to kind of wrap this up.
Thank you, Dustin. Well, for the past 3 years, 90% of the transactions that I've seen involve S corporations. And the structure of the transaction is done through an F reorganization. A lot of people are not aware of this type of structure, which provides times the seller as well as the buyer the most benefits. This is a type of transaction that a lot of times minimizes the risk of an invalid S election, which makes it very appealing for buyers, as well as gives the buyers the opportunity to acquire the operating entity while treating the transaction as an asset acquisition. It's similar to a 338 H10 election, but is a lot more flexible as to who the acquirer can be. There's no restrictions in a 338H election. Target and the purchaser and the buyer have to be corporations. In an F reorganization, there's no restrictions as to who can be the acquirer. So this type of structure, it's been quite popular in the last 3 years, is what I've seen the most.
Yeah, that's great insight. And I think that kind of leads into the last question that we have, especially, we get this from a lot of individuals that are considering a deal in the not too distant future, but want to make sure that they're covering all of their bases, especially from a financial and tax planning standpoint. But if you were to advise a client on what steps they can take to ensure the most tax efficient sale of their company as they can, what are some of the key points that you would advise them on?
Well, the first thing I would say is we're looking for not only tax efficiency, but to make sure that you get to keep the most amount of cash in your pocket, right? And the first step I would advise a client to take is to make sure they have proper counsel. An experienced corporate attorney, depending on the fee sensitivity, hopefully a firm that also has a tax attorney that can help you with the structure. If that's not possible, and even if it's possible, I always advise to engage a CPA with significant M&A experience, right? A CPA can help you not only estimate the taxes that you may have to pay in the eventual sale of your company, but they can help you make sure that your books and records are in line and that you are appealing to a potential buyer, but that your exposure if that potential buyer wants to buy your assets and not your stock. You need to understand the value of your company, whether that means engaging a professional to do a valuation of your company, or if you have the in-house talent to help you figure this out, it's good to have the tools to negotiate with a potential buyer, to be able to get a higher purchase price if you're going to have to pay more tax if the buyer wants to buy your stock. I mean, there are several things that a lot of sellers forget to consider. And it happens more often with smaller companies. If you're getting the purchase price that you had in mind, and even if it exceeds your expectations, you may want to be excited and wanting to sell as quickly as possible. And you're not really considering all of the consequences of the structure of the transactions. A lot of times happens that you don't want to sell all of your assets. And this happens a lot in the healthcare industry. A lot of healthcare companies, sometimes they own their real estate, they own their buildings. Either the seller or the buyer don't want to buy the building or sell the building. So it's very important to understand the assets in your balance sheet and what you want to sell or keep with you, and structuring the ownership of those assets prior to any transaction is very important. It could result in adverse tax consequences if you don't do this beforehand. And finally, like I said, definitely engage expert advice as soon as the decision to seek a potential buyer is made, or at the time to receive the letter of intent at the latest.
Yeah, I think those are great pieces of advice. And, something that we always tell our clients is that, a sale of the company is something that is a momentous event in their careers, and it's something that you shouldn't take lightly. So it's important to have good advisors behind you that can walk you through all the aspects of a deal and the potential ramifications of it. So I think especially from a tax standpoint, you make a lot of really good points as far as points to consider that most business owners or shareholders wouldn't otherwise think about from a valuation standpoint and a deal structure standpoint that ultimately translates to the important parts, which are how much cash you get in your pocket. Well, that about does it for our podcast on tax implications of a transaction. Would like to thank Yaury and Dustin for their time and joining us here today and lending their insights. For all of our listeners at the podcast, feel free to access this recording through the App Store or through the links on the respective Provident Healthcare Partners website and through Kaufman Rossin as well. So appreciate everyone's time and feel free to reach out to us with any further questions.